Welcome back to New Money. This evening we're discussing investments. My guests, Henry Biddlecombe and Paul Hanson. If you'd like to email them, you can send your query to info@anchorcapital.co.za. Before we get on to emails, Henry, I want to talk to you a little bit about AGOA. I mean, our relationship with the USA is probably at an all-time low, and we have this benefit of AGOA. Firstly, can you just explain to viewers what this AGOA is all about, and is there a likelihood, and what are the effects of the likelihood of this bill that is currently going through Congress to maybe reconsider South Africa's involvement in AGOA?
Yes, I think just broadly speaking, AGOA is one leg of a very complex web of trade agreements between countries that are a member of the World Trade Organization. AGOA itself deals with very specific products that are exported from here to the USA. And of course, given our stance on global policy, and we won't get into that now, the US is obviously reconsidering our status, or at least the nature of the AGOA agreement, which I can't blame them for. So, what happens if that agreement falls apart? Basically, on a numerical level, it's very negligible, the impact. I think economists who look at this sort of thing every day estimate that it'll have a sort of 50 basis point negative impact on GDP. I think it'll impact South African exports to the US by about 2.5% negatively again. So not a huge number to worry about as an investor, but I think more it's just a continuation of the kind of loggerheads that we find ourselves at with Western capital markets, but nothing. I don't think it's something specific that we should be worrying about as investors.
Henry, you talk about that. I can't believe the difficulty we're having, particularly with trusts in South Africa, because of grey listing, to try and do business with institutions, to try and move money with institutions and within institutions, move out of it. I mean, the grey listing has caused us problems. We'll talk about that another time. But I'm going to go to the emails. Paul, Marcus in White River, he's got a question for you. He says, what do you think a balanced portfolio should look like?
It should be balanced between shares, bonds, cash, and offshore and local, mixture of offshore and local. So that's where the balance comes. You've got a mixture of all the different asset classes, and you've got a mixture between local and offshore.
And Paul,
so it's balanced out.
You can have a more aggressive balance and a more conservative balance in terms of the different type of equities within that portfolio.
Yes, so if you want to go as high, typically the highest allocation to equities is 75%, and the more conservative funds would be like 35-40%, maybe down to 30% in equities. Yes, so depending on the risk profile of the fund and the investor.
Henry, any comments you'd like to make on that? Balanced portfolios?
Yeah, I think again, we've spoken about this many times before. It all comes back down to your investment time horizon. If you're a younger person, you should have a higher level of exposure to stocks, and vice versa if you're at or beyond retirement age. But a very good principle to follow is to have a neutral sort of level. So let's say, for example, you're a young person who should have sort of 80% exposure to stocks. In an environment where perhaps you're a little bit more concerned about risk, you should ratchet that down to 60. If we find ourselves in March of 2020 again, and global equity markets are down between 30 and 40%, then you can take that back up to 90. So it's always good to just establish what your neutral level is, and then move back and forth from underweight to overweight tactically.
Henry, just talking to you about a retirement, many people suffer badly because they don't take enough risk because they're investing for retirement. I mean, if you talk someone of 35, 40, 45 investing for retirement, I know you're limited in South Africa under Regulation 28 of how much can be invested offshore, but do you think that has an impact on many people who maybe think short term, meanwhile retirement money is long term?
Well, there are two things I want to say. So the first is, if you're not sitting in equities when you're young, you're basically just trading one risk for another. It's not to say that you're avoiding risk. You're trading equity risk for inflation risk. And that's, I think, a more scary risk than equity risk through time, because that can just destroy your wealth. Secondly, the Reg 28 issue is an interesting one. I'm finding that more and more of our clients are actually foregoing the tax deduction or the tax shelter a Reg 28 account, and they're taking their money offshore and investing it in global markets, at a 70 or 80% level in terms of the mix in the portfolio. So they're happy to forego the tax benefits of an RA structure so that they can have a much higher level of global exposure. And I actually think that's not a bad way of going about it.
Something I need to look into, because I wasn't aware you could do that. So
you have to go outside the structure.
You have to go outside the structure. Something I'll talk about. I'll evaluate and talk more about in our retirement program in a week or two. Henry, also Ralph in Tukai says, and how do portfolio managers select their companies? What do they look for before choosing an equity? What do you look for, Henry, before you decide on an equity investment?
Every investment manager will have their own style. It can be a growth style or a value style. So they'll prioritize different sorts of qualities and fundamentals. But I guess, what do we teach 19 or 20-year-old graduates who are coming into our business and looking at stocks for the first time? We say, well, overwhelmingly, over the long run, the most important thing is to find companies that can consistently grow their revenues over the next kind of decade. So is this business operating in a market that's growing? Can this business grow its share of that market over the next decade? If that's the case, almost everything else doesn't matter. So that's the most important thing. And then you start looking at things like valuation, which again, over a period of a decade or more, play a much smaller role in the ultimate return that you generate from that stock. So you can look at things like valuation in the shorter term as well. And I suppose capital allocation, all of these sorts of things, you can get quite technical. But I think overwhelmingly, you want to buy companies that can grow their revenues consistently for the long term.
Paul, any comments from you?
Yeah, I mean, absolutely. And you want companies to be generating a decent return on their capital or return on equity, so hopefully higher than the interest rate environment that you're in. We're talking about our bonds yielding around about 11% now. I think our 20-year bond is around about that. So you want companies to be generating good returns on capital, good returns on equity, and and just being managed well. And soundly.
And that's where sometimes sentiment comes in, because the headlines of the day is the sentiment which drives in the short term, and people don't realise you've got to forego and not listen to all that noise. But Paul, Joe in Ramsgate says, my share portfolio has not been doing well in South Africa as I'm not in gold and resources. Should I sell some of my underperforming stocks and go into these sectors?
Yeah, I think there's a huge temptation to do that, I'm sure, in the South African market. But as I say, if you look at Pick n Pay down over 70% from 10 years ago, Sasol down over 70%, Absa and Nedcor trading where they were 10 years ago, Absa even lower, Rembrandt, one of our famous old blue chips, trading where it was 10 years ago, lower than 10 years ago, and listed property trading more than 30% below where it was 10 years ago. So I'm just looking at a whole bunch of, in other words, there's lots of companies and shares in the JSE that are trading at very low levels compared to history. And that's usually not the time to sell them. That's the time to be accumulating with money that you want to keep in South Africa. So I don't think you should be selling, no. And obviously, commodity prices, Henry mentioned the gold shares have been lagging the gold price recently. Obviously, that's always a high risk. That's for high risk money, because who knows what's going to happen to gold tomorrow, next week, next month, next year. And no one ever does. But it does look like commodity prices are possibly turning on the whole. So something like Anglo's is still down over 30% from its high, and it started to turn a bit in the right direction. The platinums could be bottoming at this stage too. So there is hope. There is hope that the next 10 years should see much better returns than the last 10 years.
And I think what people need to realize, when you're investing in markets, when you buy a property, as I said in the beginning, when you buy a property, you do think long term. Even companies, and individuals sometimes value their property at cost. They don't even value any appreciation. However, because they get these regular reports from the investment houses and portfolio managers, they see value on a daily basis, weekly basis. Henry Stewart in Bedfordview asks, do you see a recovery in both prices of property funds and a return to reasonable income distributions?
Yes, I think if you look at the distributions that the property companies are paying, or the yields on the property stocks, they are decent, right? You can very easily pick up a dividend yield of kind of 11, 12, or 13% in that space at the moment. Do I expect much capital appreciation from that space going forward? No, I don't. And that's a reflection of the conditions, the local economic conditions. So, the property space for a long time, and we've spoken about it before, was the hottest sector on the JSE, and you were getting 10% capital appreciation every year on top of a very, very strong yield. I think those days are over. So it's a good source of income, but don't look for capital appreciation there, I don't think. Maybe the question you should be asking is, why would I own property stocks right now as opposed to, for example, government debt, which is yielding a very similar number, but with a much lower level of capital risk and volatility? And that's a question we find ourselves asking today.
Paul, I'm going to sneak in one more quick question from Walter in Tongaat. He says, my offshore portfolio is almost 95% equities. What other investments can one make globally to diversify some of my investments out of equities? Henry mentioned the high yields in US Treasuries. Your comments, Paul?
Henry mentioned Bitcoin. No, I dare not mention Bitcoin. No, that's had a tremendous run. But yeah, I think it's listed property offshore obviously is a possibility, especially if economies are turning in the right direction. So I'd say global listed property, it had a big knock because of the rise in interest rates and the weak economies in the last year or so. But that could be a possibility. Definitely global listed property, and obviously bonds generally.
Henry, would you be agreeing with that? Coming a bit out of equity, because you spoke about equities being a lot less.
Yeah, so look, on the bond side, I think right now I favor shorter duration securities. So, remember, when you're buying a long-term bond, a small movement in the interest rate can have a big impact on the price of that bond. And I'm worried that rates are ticking higher for now. So at the moment, I'm sitting in floating rate treasuries, for example, or much shorter duration bonds. So you've got kind of 12-month dated money market instruments and short duration bonds. And I'm waiting to see where yields stabilize. So, for example, on the 10-year, I'd probably start looking at longer duration stuff if it reaches the 4.7, 4.8% sort of level. That's where highs were tested last time. But for now, I'm worried about long duration stuff.
Well, guys, we've come to the end of our program. Paul, Henry, thank you for joining me this evening. It's important to note that our program tonight is to provide information and should not be construed as advice. Next week's program, we will be dealing once again with the healthcare industry. And if you need to get hold of me, my details will appear on the screen. I'd like to thank you for watching, and good night.